day. Thank you for joining me. I'm Ryan Kun. I'm going to be taking you through Diageo's half-year 2019 results. Looking at the recommendation. The group has a strong portfolio of brands, a global footprint, and structural growth tailwinds as it focuses on the premiumization of its brands. As such, the medium-term outlook for organic revenue growth remains positive. Marketing initiatives are expected to put pressure on the operating margin, but continued cost discipline should negate this. The group's high profitability, strong cash generation, and disciplined approach to its capital structure give confidence that the balance sheet risk is low. This should enable the group to return excess capital to shareholders through share buybacks or an increase in dividend, which is likely to underpin the share price. As a result, we recommend an overweight position, given the quality of its operations and its attractive growth. Looking at the financial highlights. Revenue grew by 6% and organic revenue grew by 7.5% year-on-year, which was due to the increase in volumes of 3.5% and a favorable price mix increase. Adjusted operating margin, excluding exceptional items such as the gains on disposals of its brands, grew by 5%, resulting from an improved price mix, efficiencies from the productivity program, and strong organic growth. Marketing spending rose by 9% and the marketing investment rate increased from 9.7% in half-year 2018 to 10.1% in half-year 2019, indicating the increase in marketing expenditure is positively influencing revenue growth. Adjusted earnings per share grew by 14% to 76.7 pence per share due to the higher EBIT. Interim dividends increased by 5% to 26.1 pence per share. Diageo's target dividend cover is between 1.8 to 2.2 times. Currently, the company is tracking at the low end of its range at 1.84 times. The historic profit and dividend increase indicate that dividend cover should reach the high end of its target range within 5 years. Looking at the cash flow. Cash flow from operations increased by 32%, largely due to tax savings. Free cash flow rose year-on-year because of operating profit growth as well as tax savings. This gave Diageo ample room to pay dividends, a trend which is expected to continue. The board has approved the share buyback program. The total buyback for full year 19 is expected to be £3 billion. Diageo's total assets increased by 7% in the current year and total liabilities increased by 12%. The increase in liabilities is primarily due to an increase in bonds to the value of £1.7 million. The net debt to EBITDA ratio strengthened by 14%. This was a result of an increase in operating profits and additional cash and cash equivalents. Given the profitability and cash generative ability of the group, we feel gearing is not problematic and that balance sheet risk is low. Looking at prospects. For 2019, the group has created large marketing initiatives and productivity programs across all brand platforms. This is expected to drive consistent top-line growth and margin expansion in line with medium-term guidance of 175 basis points. The three focus areas for the company are Scotch, US Spirits, and India. White Walker by Johnnie Walker is a limited edition that the company is currently running. This has seen strong sales in the current year, and the product will be rolled out to markets globally throughout 2019. Captain Morgan has put on a bit of pressure on US Spirits. Diageo has continued to invest in Captain Morgan marketing drive, which expands the consumption beyond Captain Cola in an effort to drive sales and improve effectiveness of the brand. India has seen strong marketing drives, which is expected to continue into 2019. The Keep Walking India campaign will continue to ensure the brand is more accessible to the younger, more affluent consumer. If you would like to place a trade, please speak to your financial advisor or contact the trading desk. A comprehensive company analysis report on Diageo can be found on PSG Wealth's online trading platform. Before we end off, please take note of the following disclaimer. Thank you.